Hi, investors. Nick Garner here, and today I'm going to do a combination of things, I guess. One is record a bunch of stuff which helps me remember all of this information that I've been working on for the last couple of days, and as importantly, help you get your head around some of the data, and then you could draw your own conclusions as we go through this. Now, it may not be as structured as I'd like, but I'll do my best. And with that in mind, let's go. The principle I'm working to is that one starts with correlations between behaviors, and then one can look at the correlations between numbers, the data, in other words, the price data, demographic data, not price data, GDP data, and all this kind of stuff. Um, this table is originated from propertydata.co.uk, and you can see lots of information, but broadly it shows data per postcode district. So there's about 2,200 postcode districts, and therefore this is quite helpful because it helps us understand the relationships between certain demographic characteristics and capital growth and then and yield actually, and then from there one can say, for example, if this area has these characteristics, then that makes it especially interesting. And broadly, the I've color coded everything, and I know it's just a lot of colors, but anyway, I'll do my best here, and I'll just freeze that. And then what we can do is when we start to drill down into the numbers, then it's easier to make sense of what's going on. And what I'll do as well, just to make it easier to comprehend, I will reduce the number of decimal points and make this smaller, because actually we're only really I'm only interested in areas where there's a lot of correlation. So the correlation formula works like if it's a 1, it's very tightly correlated. If it's a -1, it's exactly opposite correlated, which weirdly makes it correlated. So in other words, yeah, so it's an exact negative or positive correlation, and then everything in between. So a 0 means there's just no relationship between, for example, population and average asking square foot. So the bigger the population, well, that doesn't really change very much, for example. There are other metrics like population growth and so on, but for the purposes of this, we don't have this data here, and I'm not going to go and try and find it because there's a lot of legwork. But I do have population growth data in a different spreadsheet, which I'll talk about shortly. Anyway, what I won't go into everything, but I'm just going to pick out the things that are definitely interesting. So, for example, the higher the average asking price per square foot, the lower the sales turnover. That kind of figures, I guess. Uh, the and what I'm looking for here as I go through this are just things that are useful as general indicators. Obviously, very high correlation between the population size and the sales per month. Well, that figures. The other thing that is kind of interesting is the relationship between social grade and house price. That figures, I guess, but this is a foundation of our work, that we look very closely at the demographics. So we're always interested in higher social grades in an area because the correlations are very clear that the higher the social grade, the more able they are to generate wealth, and therefore they're able to sustain higher house prices and all of that stuff. So that's quite an important relationship. But what about yield, for example? How does that work? Well, it looks like with yield, um, the most interesting correlation is, well, there are several interesting correlations around house price. For example, uh, the correlation between higher house price and higher yield is least for two-bedroom properties, but greatest for five-bedroom, which makes sense. So in other words, big houses, low yields. That's fine. But there's also another one, which is that yields don't really have much to do with sales turnover, which is quite interesting. I hadn't really thought about that. And that yields go up in higher crime rate areas, which also figures because generally crime and poverty tend to go together, and also yields go up if you're in areas where there's a lot of social renting and private renting, which also figures. So these are poorer, lower demographic areas, and that and they are more appropriate for rental yield. Now, one thing I would say is that whenever we look for property, we're looking for high yield, low crime. And you can find these areas because the correlation isn't 100%, it's 40%. So there are plenty of places where it's a low crime, high yield, i.e., the lower end of the demographic scale, just a nice place to live where you don't have lots of rich people. And that's exactly what we find all the time. Now, the other thing is you've got the inverse correlation between yield and social grade, which we talked about earlier. So basically, the richer the place, the less the yield. And what else can I tell you that looks interesting? Rental turnover is an interesting one for us. So we pay quite a lot of attention to this metric because the greater the rental turnover, the more demand there is, and therefore the quicker you're going to rent your property out. And generally speaking, there is a small correlation between more income and more turnover, but the rental turnover correlation seems to be the highest where there's quite a lot of large houses, which is interesting. I don't know why that is, but where you have high asking rent for large houses, you also have a lot of turnover. I don't know why that is. Strange. But generally speaking, it's 2 and 3 bedroom properties that interest us the most, because they just work well for buy to let. Now, beyond that, the next question, of course, is what about capital gain and which areas are doing best and so on. So let's have a look at that. And here we have the 5-year. I'll make it bigger for you. Right. So what I see here are lots of negative correlations, which is also quite interesting. So, for example, the higher the asking price per square foot, the lower the capital gain for 5 years. And that's actually kind of interesting. So what it means is that the more expensive the area, the less capital growth you're going to see. And that's important because a lot of people say, well, surely expensive areas are going to grow the most. Well, that's just not true at all. And that's what I see from my experience and also what this data is telling us. For example, here, the properties with big 5-bedroom houses for rent, they have the least capital gain, for instance. And it just kind of nukes the whole assumption of, well, buy in an expensive area, it'll always go up. That's just not the case at all. And that's why, in my case, I I'm looking for capital gain in mid areas where there's affordability left. So nice places which are fundamentally good, but not being overbought. And beyond that, that's quite interesting. So the capital gain, there's not, again, this type. So ABs, if you have a high, uh, if you have people with AB social grade, a lot of them, you're not going to get much gain. But that's because they correlate with high average prices. The bottom line is that you will get your capital gain not through buying in expensive areas. You get it through buying in cheaper areas. Um, the other thing that's kind of curious is how 1 year capital gain is very all over the place. When I look at it in when you look at it here, in fact, for instance, the correlation between 1 year capital gain and 5 year gain is only 50%. And that means that if an area grows a lot now, that doesn't mean it's going to grow a lot long term. It's likely to, but based over a 5 year time frame, that's not necessarily the case at all. And therefore, when I'm looking at growth, the characteristics of areas which will grow well, I'm really thinking about the quality of the area, the the movement of the area, sort of socially speaking. So is there a lot of new build around? Is it just fundamentally nice? Will it attract higher social grade people? And those people, based on the correlation data, those people tend to be able to make more money, and therefore it attracts more higher social grade people as well, of course. And then overall the area lifts because the competition for prices or competition for property keeps increasing, and people have the affordability, so they can afford to pay more, and therefore the area moves up. So I think it's very important when predicting capital growth to really look closely at fundamentals, like is it a nice place? Are the transport links good? And so on. But there are certain rules, like if an area is too poor and too deprived, too much crime, those better off people will just not want to live there. All right, now the next thing is looking at the GDP data I've got. Now this is for cities, so this is a different data set. But what I've noticed looking at this in some detail is that if you're thinking about like things on a very high level, so we talked about a relatively granular level, which is postcode districts, and we've said generally speaking, if you want growth, don't go to the most expensive areas. Go to the nice areas where people who can afford to bid up the price want to live, and start with the fundamentals really when you're looking at capital growth. Now, there's another thing that's important. In fact, before I get into the GDP stuff, I'm just going to show you this. That this huge table won't mean a lot necessarily, but the main lesson I've picked up from this, from having trawled through this for about 2 hours this morning, is that that when I look back at history, and I'm looking at house prices going way back to 97, and I'm comparing them against today, and I'm adjusting for inflation, and I'm looking for correlations between prices from the past and prices from today. One thing I've noticed is that uh, that when I look at house prices, house price correlations, and remember that if it's below 50 or 0.5, I'm like, well, okay, that's kind of interesting. And above that, I pay a lot of attention. And generally speaking, what I've noticed is that in looking at house prices from way back, or so the let me just pause. I'll get something up for you. Right, I'm back. And here are property cycles, and they go back way back. This is 1845 and so on. And property cycles have a particular cycle. And you have boom phase, or crash, recovery, correction, boom, etc. And you can see this mapped out here. And this is the last property cycle for Northwest. And what makes this interesting, for me anyway, is that that when I look at that cycle, the last time around, the last boom phase, which is 2004 to 2007, and I look for correlations between then and say the last number of years. It's hard. So I'm just going to talk this through instead of try and show you loads of numbers. But the bottom line is that there's very, very little correlation between areas that grew massively in the last boom and areas that have grown recently in the last part of the cycle. So in other words, 2018 to date, there's just very little correlation. So the areas that grew massively then aren't necessarily the areas that grow massively now. And what I get from this, but there's a little bit more actually. So if we go back further and we go back to 2003, so the last phase before the last cycle. So again, just to refresh your memory and so on, the flat period before the last boom, in other words, the recovery phase before the last boom. There are many more correlations. There are many more correlations, still not a great correlation, but essentially areas that did way back in the day are now doing well again. And what I think is going on is essentially a huge rebalance where areas that got overcooked in the boom, the last boom, held their prices relatively speaking, and then but there isn't the value anymore. So therefore, they're not the boom areas now. So history never repeats itself, but it certainly rhymes. And what I'm looking for are the patterns to go, okay, well, the pattern that I'm seeing here is, okay, well, last time it boomed, great. This time it's not. That's okay. I'm going to look somewhere else. But what am I going to look for in those other areas? And the answer is, I'm looking for good demographics, or the foundations of good demographics: low crime, good transport links, nice housing stock, and so on. And I'm not going to just rely on the fact that it did well last time, therefore it'll do well this time. In fact, I will kind of go the opposite. I'll say if it was too strong last time round, it's too overcooked, and therefore I'm looking for value. And then the question is, what does value look like? Well, for me, one of the best metrics is the I'll open this up. One of the best metrics is this is all the MSOA data mapped out on a map. And for me, I would say it's the difference in house prices from 2007. So if the house price, if there's a gap, now this is a big topic, but broadly speaking, if an area is fundamentally weak, economically weak, then it's a problem. And therefore, you know, as with all these things, it's never simple. There's always a caveat. There's always an if and a but and a maybe. And therefore, what I'm looking for are areas that promise growth, that show value, that are economically robust, and that the trends are solid. So I'm seeing some of this in the Northwest, for example, and I'll show you in a moment. Anyway, assuming all of those things, like strong underlying economy, market hasn't woken up yet, then that's interesting. Now, the other thing that is important to note, by the way, is the relationship, the crash. Like what happened in the crash? How serious was the crash? And for that, I've got this data. And it turns out that nominally, i.e., just in averages, that the areas that crashed the hardest were the richest areas. So South Buckinghamshire, Warrington, by the way, interesting. Um, but broadly, what I see are these fundamentally weak areas that grew massively high and then crashed hard. That's what I'm seeing, roughly. And again, it's like just general correlations. You can't say in absolute, like one to one, this always happens. But I can certainly say that the, there are a couple of relationships. One is areas which were speculative, that grew speculatively, but really there was too much poverty. And if you remember in the last crash, what happened was people were getting mortgages that shouldn't have. And when the crash came, then everything got frozen and essentially the market tanked. And what I think happened was that certain areas just got overbought, as I say, but some areas were poor, like Warrington, Coventry, Blackpool, good example, and they just plummeted because the market froze essentially. But if you look at areas that did really well, it turns out that rich areas in London, now this is due to a unique effect, which is the foreign money coming into London just after the crash. And they came to London for safe haven, and a lot of it was dirty money, as it were, laundered money, whatever. That's not going to happen again, I don't think. But that then had a huge effect in the southeast and London southeast. But areas like, um, if we take Manchester, for example, and I'll just sort this by name, A to Z, places like Manchester did okay. And they didn't drop that much, and yet they were robust economies. So the reason we'll talk about the economy stuff in a minute, um, but I'm just doing this by alphabetical order because that way it's easier to just see what's what. And there we go. All right, and if I go to Manchester or Stockport, A, B, C, D, F, G, H, I, J, Manchester, there we go. There. It's 12% for Manchester, but if I go to Stockport, which is just in the area, so we've got Salford actually, which is a good example, 6%. And overall, let's see, Stockport, 11%. Just generally speaking, I think when I look at a lot of these areas that just weren't that are neither that poor nor that rich. Those kind of middle areas, they did okay. And that's interesting. And it's also very encouraging because what I think is that these poorer places, oddly enough, they can handle a crash quite well. It's the really poor areas that had a lot of speculative purchases, market speculative activity. They're the ones that absolutely failed. And I would say, as a general rule, what I take from this is that uh, that one has to be careful about the strength of the local economy. And if a market goes up a long way, it doesn't necessarily mean it's going to crash a long way. We can see here from 03 to 07 in that spreadsheet, 03 to 07 here, that in this particular patch, it hardly crashed at all. And therefore, I just think, okay, that's fine. So it's okay if a market grows a lot. That's the short of it. And but look at the underlying economy and make sure that's good, which takes me into here. And this data is citywide data. It's local authority data, in fact, and I quite like it because it shows things like gross domestic product, which is a really, really interesting metric. Now, what I found was with household disposable income, that's pretty much linear. And what it doesn't really factor in is the average. I mean, it does factor in it's the average household disposable income, but it's not varied enough to be interesting, as it were. So income goes up, fine. But what I do find interesting is gross domestic product. And uh, this is essentially the amount of money that's going through the local authority jurisdiction over time. So just the amount of cash piling through. And this one is the active businesses. So per local authority, number of active businesses over time going from 2015, as you see. And then finally, this one is, I'll hide this because you know what's not very useful. This one is house price inflation. And we can see that GDP is going up. That's good. House price inflation, it's gone flat. But what does that tell us? Well, Blackpool's a funny old area because it's not all poor. There are a lot of places around Blackpool that are fine, but Blackpool has a reputation for being poor, and people aren't that interested in it, and therefore they're like, yeah, I'm not that interested. I'm not, it's not working, kind of thing, or there's just a lack of drive to drive up prices. But some areas like Manchester, you have growing GDP and flatline in new businesses and massively growing house price inflation. And the reason I think that's happening is because investors have this idea that that the growth is there, and therefore if it's been there, the growth will continue. And I think largely that's a good argument. Because one of the characteristics that I've noticed from looking at this data is that when prices rise, they kind of hold, as it were. So it reaches a kind of point, and people who want to live there, they'll pay the price basically. There are areas which are obviously declining in value, but generally, if the demographics are stable in an area, so will the prices, roughly speaking. And uh, and so with Manchester, what I see is like rising prices, and as long as it's not too speculative and the underlying demographics are solid enough and the GDP is growing, then the prices will hold and plateau out, and then that'll be that for the next 20 years, relatively speaking. Now, prices will go up in line with inflation or whatever, but if you're talking about prices getting ahead of inflation, which is really the key thing to growing your wealth, then that's where you look, and and so on. So right, I have a ranking system, and I'll just go largest to smallest on my ranking. I think my point about a lot of these areas in like Sunderland, Barron, Furness, and so on is that if there's a correlation between growing GDP, growing number of businesses, and flatlining house prices, then I'm interested because I think there may be some value. But I also think the trick is to avoid the worst areas and go for the better, low crime, mid to higher demographic areas where there's good yield and people are looking for value, and where the yields are sensible. All right, now here's my ranking, and I've filtered out everything with low yield because I'm looking at the probability here, and you can see there are places like Coventry which are interesting. Now, the issue I have with Coventry is GDP is declining, but businesses are growing and house prices are growing. So maybe that's interesting, but I would rather look at somewhere like Oldham, for example, but whenever I see a big spike in prices as opposed to a steady trend, that worries me a little bit. And I see that with Liverpool, for example, where there's a big spike in prices, but actually the overall trend is just not very healthy. And then I see places like Blackpool, which I actually think are kind of underbought in a weird way. So, for example, here we've got declining relative to inflation, by the way, and then you have a big spike. But then you have really all over the place GDP, and it's a bit variable on number of businesses opening up and so on. So that to me, Liverpool feels wrong, and I'm not so sure about it at all. Barrow-in-Furness is interesting in that GDP is growing, businesses are declining, house prices kind of growing. Mm. Uh, and and anyway, so what I want to do is a very systematic approach to this, going through each of these areas, looking at what's going on, and then drawing a conclusion. I think um, for for value now that's solid, I would be looking at the Greater Manchester conurbation. I'll just open up the map so you can see. So I'll visualize this for you. Generally speaking, if there's a lot of brown, that's a lot of growth, broadly. And it's all relative, by the way, but the way this system works is, for example, L24, there's just relatively little growth. It's just flat around there, for instance, and L26. But you can see a lot of growth around here, around the sort of suburbs surrounding this area. But what I'd be concerned about with Liverpool is long-term growth and whether it's kind of overbought and thus whether it'll crash or not. Um, I'm going to pause, give this some thought, and then do a kind of summary wrap up. Okay, I think there are general rules one can apply. And one is that just because it did well last time round in the last property boom doesn't mean it's going to do well this time round. And therefore, I think it's better to pay attention to post-crash characteristics and and for working out what areas did best in the crash, I think it's a case of looking at the demographics and seeing what the characteristics are. And broadly, the characteristics were that which areas which did best in the crash were those areas which were not too poor, kind of middling areas basically, and they weren't overbought too aggressively. Although saying that, that's not necessarily the case. But if I go, there we go. I would say generally it's these kind of middling, yeah, it's these middling areas which have, yeah, it's these middling areas. And there isn't much of a correlation between what happened in the boom and what happened in the crash, oddly enough. So therefore, when I'm thinking about predicting the future and which areas are going to work best, I'm probably more interested in areas that have had a lot of growth, but are still fundamentally quite sound. In other words, the yields are still decent. Like it grew a lot, but the yields are there, and therefore it still fundamentally works. So I guess the big story here is start with fundamentals and kind of work your way back from there. And don't get obsessed with the idea that just because it was successful once, it'll be successful again. It's not necessarily the case at all. And I think the hottest areas, the best areas, the ones, as I said, with low crime, decent demographics, good location, which were just underbought in the last property cycle. Because it just seems to me that cycles kind of rebalance themselves. If it got too hot last time, it's going to be a bit cooler this time because there is a fundamental thing around affordability and you can't really get around that. So I guess in final summary, I would say that it's all about the demographics and the quality of the area and the GDP and so on. Now, nothing is 100% correlated, but if an area is growing, and it's decent, and it's shown good growth over the last 5 years, and it has value in it. And the way I look for value is where it is in relation to 2007. So that would be the last peak of the last market. And if it's relatively low compared to that, but it's been growing solidly over the last while, then that's a very encouraging sign. Then I think there's value there, and I think it's got headroom because it was that much higher way back in the day. It's here now, and there's an opportunity for it to rebalance, assuming that I've got a historic trend to tell me that yes, it's working because the prices are marching up in this little patch. And then what I would do, of course, is just look at stuff on a broader citywide basis. Bradford, by the way, is a very peculiar area, and one has to just be conscious of the demographic issues with Bradford. Um, and therefore, I'm also interested in the long-term economy, and that's why I keep arching back to Manchester, because when I look at the long-term GDP of different areas, I really want to make sure that it, it's going the right way. Um, and let's see. Yes, so broadly that's that. I think, yeah, okay, I'm kind of running out of comments and stuff. I'll pause once again, get my final thoughts together, and do final. Okay, so what are the golden rules? They are: look for trends at least 5 years long, because short-term spikes in prices don't really tell you a whole lot, actually. They don't really correlate with long-term trends. So just because it's doing well over the last year doesn't really mean it's going to do well over the long term. So I would look for correlated trends in an area on where there's growth. So look for the areas where there's growth, because that tells you that people are competing to be there. Pick areas which have good demographics. So that's plenty of social grade C1, 20%, 30% social of population social grade C1. Really just use your foundation thinking, concentrate your foundation thinking around the quality of the area, and put yourself in the mind of somebody who wants to rent or buy, and ask yourself, is this actually a nice area? Because it's very easy to fall into a trap where you go, it's got to be good because everyone else is coming in. I don't really like the area, and I don't like the housing, but you know what? It's growing. I'll buy it. Very poor areas of Blackpool city centre generally is not doing great, because people don't like living in tiny little apartments. And would you want to live in a tiny little apartment 20 floors up? Probably not. So why would somebody else want that? Some people like it, but not many, relatively speaking. People like houses, and so on. So anyway, always look at the foundations for these things, and always sense check it with asking yourself, is this basically a nice house? Do I like it? And why do I like it? And would other people who would make good tenants, would they like it? The the next level up is looking at the long-term economy of an area and asking yourself, is this going the right way? And the reason this is important is because it's like flowing with or against the tide. If you're swimming against the tide, it's difficult. If you're swimming with the tide, it's easier. So, so pick those areas where the local economy is on the way up, that it's robust, that it's attracting the right kind of people, and then you'll pick the right area. Um, so sorry, it's a complex topic and it's kind of difficult to verbalize. I know a lot of this stuff at a very intuitive level, but to verbalize it for you and make it make sense, it's a whole thing. So taking it from the top, I guess, the base is the city doing well? Is it going the right way? Is it attracting industry, the right kind of people, increasing wealth? Then, is that area overbought or not? is it overbought compared to where it was in 2007? If it's above the 2007 high water mark when you adjust for inflation, then okay, that's okay, but it's starting to get risky for me. And I'm more interested in areas which are slightly below that high water mark. But in any event, I care about the shifting demographics. Is everything kind of moving up? Are the demographics getting progressively better and better in that area? Is it a fundamentally good area? Good location, nice green space, low crime, good shops, all of that stuff. And if everything stacks up on this whole pyramid, then great. Now, the next one, of course, above all of that is the housing stock, and is the housing stock decent, and is it good value, and are the yields good? And the other thing to say above all of this is that there are certain metrics which kind of say it all: capital gain and yield. And broadly, it's that sweet spot between where people really want to live there, so the prices are going up, but the yield is there because people really want to rent there as well. And so much of this is just always bringing it back to a people thing, and always thinking in those terms. So one needs the numbers to find out what's going on where, but ultimately property is a people thing. Anyway, I hope that helps. I know it's a bit rambly. I hope you got some bits and pieces of knowledge out of this. I certainly have, and it affects how I'm going to look at stuff. And I think the main thing I'm changing is I'm not referencing what happened in the last crash. I don't think it's relevant. If an area did great last crash or badly, it doesn't really make a great deal of difference. What I'm more interested in uh, is just good demographics, the here and the now with what's going on. All right then. Well, thank you very much.